Good morning, everybody. It is Greg Schnell, and I am here with the Stock Charts Outlook. And today I am joined by Don Vialoux, who comes to us from Canada. He's a great technician up here, and we have a big show for you. There's lots going on. Don has he was the past president of the Canadian Society of Technical Analysts. I sit on that board today, and I'm the Calgary chapter chair for the Canadian Society. Don and I are both chartered market technicians, but he has 47 years of experience, and I have about 10. He was a former advisor to one of the ETFs in Canada, a really big, popular ETF called the Horizon Seasonal Rotation ETF, and now Don he runs two websites. He's got one called timingthemarket.ca, and he's got another one called Equity Clock. And on those websites, there is lots of information around seasonality and that type of thing. So we'll be sharing that with you. And today we have an agenda. Very briefly, we're going to cover off, Don's going to cover off combining seasonality and technical analysis. And then I'm going to follow that up with combining intermarket work with technical analysis. So comparing commodities to currencies and that kind of thing. And then we're going to do, we'll have some questions and a wrap up for 10 minutes and have you out of here in an hour. So with that, I'm going to pass the torch over to Don. If you want to take the screen, Don, and we'll start working through your presentation.
Okay, 1 second, here we go.
There we go, Don, we see your work, so feel free to.
Okay, thank you, ladies and gentlemen, for inviting me for this presentation, particularly Greg, who's come up with some very timely comments and presentations during the last little while. Just to give some background on how this thing first started, Greg did a presentation for the Oakville chapter of the Canadian Society of Technical Analysts early in December, and he revealed some very interesting charts which showed that commodity prices in general were starting to accelerate on the upside, and also the US dollar was starting to come down. And I was fascinated by his presentation because his work, although it's very different than mine, coincides so closely, and the two combine together to form an interesting story. So let's look at the story today. Let's look at, first of all, traditional investment analysis. That's where people look at cash flow or earnings, book values, all that kind of stuff. The senior investment analysts and major investment firms start with that place. Then they normally will look at the chart very briefly to see if the investment is interesting at current prices. And some have heard about seasonal analysis, but really don't know what it's all about. So that's the traditional way of looking at investments. Our way is taking that whole process and flipping it upside down. First of all, look at seasonal analysis, find out when the investment does best, either on the upside or the downside. Then look at the charts to see if there's a good entry or exit point. And last but not least, look at fundamental analysis. Now, when I talk about fundamental analysis, I'm talking about something a little bit different. I'm talking about things like economic indicators, which tell you what's happening at any particular time of the year. This chart here shows you what new home sales seasonality is all about. And notice that the red line shows that the new home sales accelerated as it got into the fall this year. Very different from what you normally see. That's a clear indicator that the home related stocks, including lumber, were set for a pretty good move on the upside. So using these fundamental indicators, very, very useful to pinpoint sectors that look particularly interesting. Now let's look at, let's see, seasonality basics. Well, first of all, what you want to do is you want to find the period of seasonal strength for the investment that you want to go into. The next thing you want to do is you want to have the data going back on seasonality. Now, my preference is to have data going back for at least 10 years and preferably 20 years if you can have the data. Now, it turns out Stock Charts does offer seasonality data. for about 5 years, and also does provide it on a monthly basis. This is very useful, but I prefer going longer. The reason being that sometimes short-term data, like less than 6 years, can skew the data to a significant amount. So preferably you use at least 10 years of data, sometimes preferably even more if you can get it. Also, seasonality is based on recurring annual events. Let's take this one step farther. Availability of seasonality charts. Well, let's look at what is available for you. It's a free service. It's available at equityclock.com. There are seasonality charts on over 5,000 charts. And these charts will show you real and relative returns as well as percent monthly frequency. So lots of data, and the price is right. Now here's an example of a seasonality chart showing the S&P 500. And this is fascinating because of where we stand right now. You can see that there's 2 periods of seasonal strength for the S&P 500. One is from the middle of October until about this time of year, the second week in January. Then the markets tend to go kind of sideways into February, and then they click in again around the end of February and go higher right through until early May. So just by seeing this as a seasonality chart, it gives you an idea of what the seasonality chart looks like, showing the months and the feasibility of these seasonal trades going forward. Now let's look at different types of seasonal charts which are available at equityclock.com. There's major equity indices from right around the world. There's major sector indices. Now it does provide some actively traded, exchange traded fund charts. The qualification there is that you need at least 10 years of data in order to have a reasonable seasonality chart for an exchange traded fund. More and more exchange traded funds have that data, but there's still a lot of exchange traded funds that have not been around that long in order to do a feasible seasonality chart. It includes all the actively traded North American equities, the S&P 500 stocks, all the TSE 300 stocks, all the major actively traded equities in the world, but they have to be fairly actively traded. It includes all the major commodities, all the major currencies. We do also have seasonality charts on treasury prices and yields, 2 years, 5 years, 10 years, 30 years. We also have seasonality charts on broadly based economic indicators, a wide variety of them. And last but not least, we have comparative and special studies. One that you may want to look at is the seasonality chart for the 4-year cycle. It shows that on average, during a midterm election year, which is where we are right now, equity markets in both Canada and the United States normally move higher right through until April. And then after that, they have a major correction during a midterm election year. So be aware of that. Usually the correction continues from the end of April right through until September. After that, equity markets in both Canada and the United States go back to their regular cycle. Now, here's the process that I suggest that you take when looking at seasonality. First of all, select your investment, whatever one you want. Then go to equityclock.com and check out the seasonality for that particular investment. Then you fine-tune your entry and exit points using stockcharts.com. And last but not least, look at the fundamental reason for this particular seasonal trade to work. Again, you can go to equityclock.com to look at major economic indicators. The key is that often the economic indicators work very, very well and help you to kind of understand what's happening. That's a good example is, say, the technology sector. The technology sector has a period of seasonal strength from approximately the second week in October until the Las Vegas Consumer Electronics Show, which just completed yesterday. Fascinating that historically after the CES show in Las Vegas, the technology sector moves lower. The question is it happening this year? And yes, it certainly is happening this year. The technology sector is being driven by things like sales of iPhone 10 and iPhone 8 and a lot of the new technology gadgets which have come to market just during the last few months. So let's look at this investment process a little bit closer. And this is an important chart for you to look at because it not only shows you a seasonality chart, it shows you the seasonality of the CRB index. Fascinating chart where it shows that on average, when looking at commodities, they normally bottom early in December, move higher from there, and actually move higher right through until approximately the end of April. So we've just recently entered into this period of seasonal strength for the commodity sector. Now let's look at how we can take that information and then apply it using stockcharts.com. The primary indicators that I use for determining entry and exit points are trend and relative strength. When you're on the long side, you want to have a security that preferably is moving in an upward trend and is outperforming the market. I also look at secondary indicators to really fine tune your entry and exit points, looking at 20-day moving average, 50-day moving average, and also short-term momentum indicators, things like stochastics, RSI, and MACD. Also, it's very important when looking at seasonal trends and trades is to use money management tools. Do use stops. Now, you determine how you use the stops, but it's important that you do use stops in one form or the other. It could be, say, a 20-day moving average. It could be a support level. It could be using as scooters. The key is you must use stops when you go into an investment process like this. Seasonality works most of the time, does not work all the time. So you do want to have that protection. Now, primary and secondary indicators for major markets and commodities and sectors are actually published every day at www.timingthemarket.ca. Again, it's a free service which is available to you. Okay, now let's look at what we have here. Introducing StockTwits. Again, it's a free service. StockTwits is Twitter for stocks. And each day we provide comments at stocktwits.com at equity clock. Now, the key is what we do is we focus on breakouts and breakdowns from identified trading ranges. These are the trading ranges have to be at least 3 weeks in time in order to make a qualified trading range. So when it breaks up or breaks down from that trading range, that's considered a breakout or breakdown. We cover most of the big stocks, ETFs, commodities. And we actually cover about 800 investments where we actually look at those charts and determine where the key support and resistance levels are. And based on that, we put out our comments. Now, right now, we have over 46,000 people that are following our comments. And on average day, we will put out between 6 and 10 comments on major breakouts and breakdowns in equity markets. Now, equity clock comments are republished the following day in timingthemarket.ca. So if you don't get them during the day from StockTwits at equity clock, you can actually get the summary of them at the following morning trading activity. So let's look at the next thing. There are 3 types of breakdowns that we normally see when we're looking at the StockTwits comments. The most prominent one are continuation of patterns. I'd say probably 85% of breakouts and breakdowns occur with continuation patterns. These are not buy and sell signals. They're more likely to be information about how the market is acting. For example, yesterday it was 13 S&P 500 stocks broke on the upside, and then there was only 3 that broke on the downside. That's clearly a bullish signal. The key, though, is to understand that these are mainly extensions of trend, but they can be very useful when you see a particular sector or market which is starting to move, and it really helps to confirm that the trend is actually continuing. A good example, last week we saw a wide variety of oil service stocks breaking to new highs. We already like the sector anyway, so every time there was an oil service stock, either in Canada or the United States, that broke out, we automatically put out a stock twit within a few minutes after the breakout to let people be aware that there's something that's important that's happening here. That's the first type of breakout and breakdown that we have comments on a daily basis. The next one is with a change in trend or pattern. This happens not as frequently. These are happening when you have major important reversal patterns. Classic typical patterns include head and shoulders tops, head and shoulders bottoms. So we're not only indicating a breakout, we're also indicating a major change in trend. A good example of that, I guess earlier last week, there was one of the stocks we've been following, a silver stock, in this case it was Pan American Silver, which completed a classic reverse head and shoulders pattern. So we dutifully, as soon as that happened, put out a special stock tweet comment, which indicated the comment as well as the chart itself. There's a third type of breakout and breakdown that we follow, and these are probably the most important of the three types of breakouts or breakdowns. When we see there's an important change in trend, fits very nicely with the seasonality, then what we do is we not only tell you that the breakout or breakdown has occurred, but we also give you the chart showing where the breakout and breakout was. We also confirm the breakout or breakdown with a seasonality chart showing exactly what normally happens. When we have that kind of a sequence, and it doesn't happen that often, I'd say maybe 2 or 3 times a week, we then feel responsible for making those comments, and we monitor those comments until eventually the seasonal trade no longer applies. So we're accountable for it. Whenever we have a seasonal trade where there's a breakout or breakdown, and we can confirm with a seasonality chart. Oops. Now let's look at some samples of what's been happening recently. And this fits so nicely with what Greg has been telling us. When Greg presented in early December, he talked about copper stocks and copper. He also talked about the US dollar. He mentioned that commodities like copper are starting to move higher and the US dollar was starting to move lower. And boy, has that been true ever since his presentation. But it fits so nicely with what I was looking at it from a seasonality point of view. You can see copper futures normally bottom right around the middle of December, and they move higher right through until approximately the middle of April. So that's the copper futures. Let's look at a classic copper stock. Here's Freeport McMoran, which is actually one of these stocks which Greg mentioned in his presentation. And sure enough, it follows very closely with the price of copper futures. So bottom's normally right around the middle of December, moves higher right through until approximately the middle of April. Very similar. So there's the seasonality on a copper stock. So let's look at the ETF, which covers the copper equities in general. And here it is, it's Globex Copper Miners ETF. And yeah, sure enough, look at this. The chart shows that there's a number of buy points depending upon which one you want to use personally. This particular ETF did bottom right around early in December. You can see it moved above its 20-day moving average. That would be a possible buy point. Moved above its 50-day moving average. Again, another possible buy point. And notice it on its relative straight basis relative to the S&P 500. Sure enough, it started moving significantly higher just as the period of seasonal strength was starting to click in. I've also included one of the momentum indicators here. In this case, it's the RSI. Notice that it also was starting to move higher. Also note that the RSI right now is overbought, so you may want to try to accumulate this particular ETF on weakness as opposed to current prices. But this trade still looks good right through until approximately the middle of April of this year. So that's copper. Let's look at another one. Here's crude oil. Fascinating. Historically, crude oil reaches a very important low right around the first week in December and moves higher, then kind of goes sideways into January, February, and then it takes off again, moves higher right through until, actually the strongest period is until the middle of March. So that's an indication that the energy sector is getting lined up for a seasonal trade from a seasonal point of view. Now let's look at, okay, let's see, next chart. Okay, if you want to play the energy sector in steroids, so to speak, you want to look at the oil service sector. And sure enough, the seasonality for the oil service sector is very similar to the price of crude oil. Normally bottoms around the first week in December, moves higher right through until approximately the end of April of each year. So there's the seasonality on that particular sector. Now let's look at the ETF and look at the stock charts is telling us are the entry points for this particular investment. This particular case, this is the oil service sector ETF, which is most widely used. And the key is that you want to look at all the technical indicators that you would like to use to fine tune your entry points. Notice in this case, you're looking for an entry point right around the middle of December. And sure enough, that's when the ETF moved above both its 20 and 50-day moving averages, eventually went above its 200-day moving average as well. Relative strength started to turn positive. And if you look at this chart on a yearly basis, you will see that stock completed a beautiful reverse head and shoulders pattern on a move about 25.54. So all the technicals, long-term and short-term, clicked in at the same time. But notice one thing, looking at the RSI, it's currently way overbought. So you may want to wait until you can buy the stock on some weakness over the next couple of weeks. But this seasonality is still very, very strong right through until approximately April of this year. Let's look at one other example, silver. Again, it's one which bottoms right around the middle of December and goes very, very strongly right through until the end of February. So that's the silver futures. Now let's look at a classic silver stock. Notice I'm using a stock as opposed to the ETF because in this case, there is an ETF, but it's only been trading for less than 5 years. I want to have more data to make my investment decision based on seasonality. So I've chosen an actively traded silver stock, in this case, Wheaton Precious Metals. And no surprises here, the seasonality for this particular stock bottoms right around the middle of December, moves higher right through until approximately the end of March. At that point in time, the seasonality turns negative. So there's the silver Wheaton seasonality chart. Let's look at the price chart. Oops, going the wrong way. Here we go. Okay, here's the silver miners ETF, one that's been around for about 4.5 years. And again, you're looking for the classic technical signals. You want the security to trade above either its 20-day or 50-day moving average. You want relative strength to turn positive relative to the S&P 500. And you want your short-term momentum indicators turning higher as well. So all these things did click in. And this particular investment still looks very attractive until at least the end of February and possibly right into March of this year. So there's 3 examples of investment opportunities that have appeared recently. All of them are a little bit overbought right now. You may want to try to buy them on weakness, but they all have positive seasonality right through until at least February of this year. So here's the connection points that you'll need if you want to use this service. Stockcharts.com is by definition, but all these other services that are on the screen, equityclock.com, which is my son's blog, and my blog, which is timingthemarket.ca, and StockTwits at EquityClock. All of these particular links are at no charge whatsoever, all free. There's a daily blog on Equity Clock, and there's a daily blog on Timing the Market as well. So lots of information there for you. Go into these sites anytime you wish and enjoy seasonal investing. There's a question period, and we'll pass it over to Greg.
Yeah. So what we've got, so Don, thank you very much. I think one of the things that I really like about Don's work is he has really simplified seasonality. he puts a couple of quick indicators on his chart, like a 20-day or something like that, to buy. So when your seasonality starts to kick up and the stock starts to move above the 20-day moving average, you probably want to get on the trade. He shows the relative strength there line compared to the S&P 500. That's a standard addition on all of my charts, is to be aware of what's going on compared to the S&P 500. And all of those, I'll call it little clues, are really, really valuable for people. So what I'm going to do now is show. So Don came through his work through seasonality. I came through mine using what we would call, Martin Pring or John Murphy's intermarket work. And what we're going to cover off on the technical analysis area, the stars continue to align for a major currency move. And the yen, the euro, the pound, the Canadian dollar, and the Aussie are all ripe for breaking out here. The commodities are breaking out everywhere. Steel and coal just kind of kicked it up in the last couple of weeks. We've seen a lot of the stuff. Precious metals have been moving, and to conclude that, we've also got the Canadian, the Brazilian, Australian, Russian, and London markets all breaking out. So these are stunning examples of how using intermarket is showing me a picture. And then Don's work in seasonality says, this is also the time we should expect this thing to rock. So I'm going to steal the chart or steal the screen here and run with quite a few slides here. And I did want to show one thing here. Here's Pan American Silver, which Don talked about. And right at the bottom here is the seasonality button. So you can click on the seasonality. And then when you do that, what'll happen is it'll bring up a chart. And you can also grab this slider and extend it out and change the number of years showing. So not sure that Don knew that, but for everybody else, and what it does here, it tells you, typically in January, this Pan American Silver has one of its best months, and November is pretty good too. So November, December, January, February, these are all big months for that stock, and you can change it to just get the last 5 or whatever if that's what you want. But the point being, the seasonality tool here, we just kind of show you which months perform better. Don's seasonality tool, the way he displays it, shows you the actual longer trend of how it might continue to run, as an example, into May or whatever. Okay, so with that, I want to grab some other data here, and I'm going to start with the currencies. And I think this is so important. I'm just going to hide the gold here, and the way I'm going to hide it, so I've got gold displayed on this chart in the gold line, but I'm going to hide it, and I need one thing here to make your life easier. Just grab my pinpoint tool. There we go. Okay, so the way I hide it is I'll leave it on the chart, but then I just go and I set the opacity to 0 and it'll disappear, so I don't have to delete it. I can just bring it up. So here what I've got is, this is the Japanese yen to the US dollar. And one of the things that I think is really, really critical, this chart goes back to 2012, and you see this big downtrend, and we're testing this downtrend right now. But also, this is the 65-week moving average. And for those of you that are Martin Pring fans, you'll know that that's a big moving average for him. But it's also really, really popular moving average in Japan. And so the last 2 times it's broken above this moving average, it actually failed and came right back down. So you can see it's been well supported at this level all year. And now all of a sudden it's starting to break out. And one of the big things that I think is always important is at the end of the year, really looking for things that are trying to change. And so here we have this ready to break out, and you can see this, this trend line's been established for a while, but all this, early half of the year, we weren't really threatening that trend line. Now we're threatening it in a really big way. And we can also see that the momentum here shown by the PPO. So that's a percentage price oscillator. And the reason we use that is, irregardless of what the price is, the percentage price oscillator will show it as a percentage move rather than showing it as an actual price value like the MACD does. So you can see that there's an uptrend in momentum. Okay, I want to quickly shoot through these charts because they're all at extremely interesting locations. And the big issue for us is just understanding when these trend changes are ready to take place. So here is the euro on a short term basis. And you can see Friday's close was a really nice one, very, very big move right through 122. But when we go on to the weekly charts, it's unbelievable how important this level is. So here's 122, and you can see that this was a major resistance level going back for almost 5 years. Then we built this beautiful base, pretty much white coffee. And for those of you that watch Bruce Fraser's work on Market Watchers Live, but here it is. It's breaking out above this previous high here, and it also looks like it's ready to just soar through this 121 level. So you start to see that take off. And we had a big downtrend here, a multi-year downtrend that it broke through. And that was pretty meaningful, obviously. And look at what the PPO is doing. It's actually turning up while still above zero. That's really, really bullish. And this is our first histogram pushing to the upside. So couldn't be more bullish on that chart. The yen chart, I forgot to describe that, but it's also on its first week, just turning up on the histogram. So that's really powerful. If we look at the British pound, and of course we all remember this Brexit spike in here, well, we're breaking out of the Brexit lows, and look at how we finished the week. We just soared above all of the 18 months of resistance, and we're really on our way. Okay, so all of these charts start to look that way. We can go and look at the Canadian and the Aussie, and the only reason we like to do that is because I'm a commodities guy, and I think it's important to see what the commodity currencies are doing. So we actually had a NAFTA scare this week, where they talked about NAFTA might not be agreed to again. But this Canadian chart drifted down, made a lower low, and then all of a sudden turned back up. And I mean, it's still closed in the lower third. But I think the important thing here is it's also trying to turn up above zero, much like the euro was. So this one will need a little bit more watching, but it's at a very critical place. And now let's go to the Australian dollar. And what we see here is it's also had a good week. Look at this, a big outside week. So an outside week is when you test lower, and so you go down, you make a lower low, but then you go on and make a higher high. This is an extremely bullish formation when you test the low, bounce off it, and then soar higher and close near the top of the bar. And I think if we hadn't had the NAFTA discussion this week, the Canadian dollar probably would have done the same. So we're seeing all of the currencies are sitting there and they're ready to run. So I think that is a critical thing to watch for. Now I want to show you some of the country ETFs. Here's the Canadian, and you can see we broke out to new multi-year highs just this year. So I know the S&P's been on fire forever, but these commodity countries have not been. And so here's Australia. What do you see here? This is like a big bullish uptrend. And Australia, I like to think, represents commodities for Asia. And when they're doing well, it's a pretty important place to get on board. So what do we see here? We see that this huge downtrend in momentum, let me just go get it. I think this is some of the most important signals in technical analysis, is just being aware what big momentum is doing. And here you have like a 10-year line where the momentum was lowering. And what are we doing right now? We're breaking out above that 10-year trend in momentum. So I'm expecting big bullish things. And of course, what's the price doing? It's starting to just break out now too. So I think this couldn't be more bullish. Like, that is everything you want in a signature for a big bull market. So when you get that opportunity, you're seeing the breakout as it's happening. We've got seasonality on side, whole bunch of things. It is just so bullish to see that show up like that. So, oops, I grabbed the wrong one there. Let me just go get that. And so on here, the big thing that when you get this, here is the TSX. Sorry, we wanted to go to Brazil now. And this is another commodity country. What do you think this chart's doing? It's absolutely on fire. 2016, we finally had a positive PPO or MACD, and this thing is just rocking, and it looks like it's just going to keep rolling up here like it has been. But this is breaking out to new multi-year highs. Like, I think I can go 15 years or something, and this thing is breaking out right now to new highs. So extremely bullish position on that. Now we can go to Russia. And what is this chart doing? That is just a beautiful breakout. New 52-week highs this week, locking it in, starting the year with a kick. It is so bullish. And, if you just open up these charts, get a little bit more history as an example, what you'll see is, these things were basically going nowhere. And all of a sudden they're starting to turn up and these indicators are just starting to lift. So here's another one where the histogram is just starting to power higher. Everything on this chart tells me you want to get long what Russia sells. By the way, that's oil. So really important thing to remember is that all of these countries are also setting up this trade for us. Okay, so now we want to get into the commodities trade, and then I want to go grab the actual currencies here. The commodities here. And what I want to show you is here's copper, and it's continuing its road higher. This is a very bullish trend, albeit overbought, but it's still running really hot here. So there's lots of room for this to go higher. Here is gold, and gold had a beautiful day on Friday, but it also came down, tested the lows of last week, and then soared up and closed on the highs. Very bullish formation, especially with the US dollar breaking down. As a matter of fact, I don't think I showed you the US dollar, so we'll try and revisit that before I'm done here. But the important thing is all of these things, if you take this intermarket where you're looking at commodities, you're looking at currencies, you're looking at equity markets in those countries, they're all starting to break out together. And that's why I think the US dollar is going to have a bear market, but everything else is going to be bullish. And when we had that situation in 2003, as the commodities started to break out, everything ran. And, we're still going to have wiggles along the way. Don't get me wrong. It's not all one way. But the really important thing to remember is that when you get this big macro setup, it's very hard for all of a sudden the whole thing to fail at once. Like it'll still pull back or whatever. But the really important part of the whole trade is that this is setting up on so many different levels, even seasonality, but including a worldwide movement. Like that's what's going on. So I think it's critically important to be aware of how good this is. And when you get these opportunities, they're not always this easy to see. But this is a huge one, and this big, beautiful base in gold here, and we're just starting to break out to the upside. And I think I was on Market Roundup a couple of weeks ago when I was talking to Tom about my gold trade, and he thought I was a little early, and I was like, no, I'm just pounding the drum. This is the time to buy. But one of the things that you'll find is, you're still going to have a couple of weeks of pullbacks and that kind of stuff. And when you get those are going to be opportunities for buying, not for selling. Let's obviously go look at crude oil. It's a big commodity that we all know. This is breaking out to new 3-year highs. That's just lovely. Like there's nothing better to say about that. And I know people have been bearish on it at 50 and bearish on it at 55, bearish on it at 60, bearish on it at 65. And it just keeps working higher every week. So one of the things that I think is important that's changed for the US is that in the US, they were not allowed to sell crude oil directly. They had to refine it first. And if they pre-finished it or made it into gasoline or diesel fuel or jet fuel or whatever, they could export that. Well, now they're allowed to export raw crude. With that ability to export raw crude, all of this historical data is going to become a lot less important because Brent is trading $5 higher than West Texas. So anywhere that they can ship a US barrel and it can get there cheaper than Brent crude that has to be shipped from somewhere too, there's a $5 gain there. And so they're going to try and sell North American crude into the world market and get that $70, not 65. So that pushes up West Texas price, which pushes up the Brent price, which pushes up. So there's a lot going on. And obviously OPEC agreed to not increase production, but we've also seen huge demand start to pick up in China. And these changes in global demand for the commodities are all starting to swing to the upside. It's such a pretty picture. And so I can't help but, be enthusiastic about the fact that it's all setting up together. Now, if we go look at natural gas, it's been one dog in the park that just doesn't hunt. And what we see here is this really important support line at 260. And for for people who have been following my blog and the commodity countdown webinar, we talked specifically about trying to bounce off this 260 level and how important it was. And this has been starting to take off to the upside. And as this starts to move, now we look like we're trying to make new 6-month highs. If you go to the US energy information, and I cover it off on the commodities countdown every couple of weeks or whatever, but we just hit a new 5-year low for amount of nat gas in inventory at this time of year. We had a record drawdown this week, which was 359 billion cubic feet, and that drawdown is so big. It was like 70 BCF bigger than the previous drawdown. So having this natural gas inventory level drop significantly early in the season, because typically it winds down all the way through to April. This is a really important time for it. And Don's seasonality suggests that nat gas doesn't usually rally here. But I think what's happening is there's a change in the charts. And the reason is now the US is building LNG terminals to ship nat gas offshore as well. And some of the world market nat gas prices are 10, 12, depending on where you are. This US nat gas coming out of here at $2 and $3 has a lot of margin in it. And so they're anxious to get it on tankers and get it out of here rather than sell it in Canada and the US, because they can get so much more money for it. Now, Russia just opened a massive LNG terminal on their north coast, and they're getting it out of there for something like 30 cents. Like, it's crazy low. So their costs are really low, and they're going to be selling into the world market too. But everybody wants nat gas because it doesn't have all of the effects of pollution, and it's not as carbon intensive. So everybody's looking for nat gas as a way of powering energy plants. And with the whole move to electric vehicles, we need more power plants. Those power plants don't want to run them on coal, so we want to run them on natural gas. So that makes this market start to perk up. So all of these things are working together. And at the early stages, it's rough. Nothing gets built out smoothly, but it's a bit like a hockey team. The first few games aren't so good. And then as the trend starts to improve, all of a sudden you end up with the Calgary Flames on a 6-game winning streak. I had to sneak that in, sorry. But anyway, you start to see how everything starts to gel and go together. We're seeing that across the commodity. So the industrial metals are breaking out. Gold is breaking out. Silver's trying to break out. The diesel fuel, gasoline, West Texas crude, Brent crude, and hopefully now natural gas. All of these things are starting to move at the same point in time. So with that, I just want to show the CRB chart because it had a beautiful outside month last month where it went down and tested the lows. And this doesn't look like much, but what's really important is this number 196.06. And what we see here is the 2-year high was 196.36, but that wasn't a closing high. So this is the highest closing high in 2 years on commodities. This thing's just getting started. The PPO and the MACD here are moving up above previous highs. This is as bullish a setup as we can get. So there's, again, wiggles along the way, but in general, the really big picture is that things are starting to lift off. So as an example, if we were to go look at natural gas stocks now, what we can do, this is the ETF representing companies that produce natural gas. So not power plants that are burning it, but the other side. And what you see here is even though natural gas hasn't broken out yet, these stocks have started to break out. And this is just in the last 10 days. I mean, this is a January 1st or January 2nd candle here as it broke above these previous highs. And, you know, this is a beautiful 6-month, 9-month base that we're breaking out here. That's just a textbook breakout. And you know what we want to see, we're seeing all of the industrial drillers and that kind of thing start to take off. So when we go look at this list, we can just click on edit here, but we can go to summary mode and just put in, you know, what have these things done in a week or a month? And, you know, these are percent changes, like 21%. So I'm thrilled with the move in natural gas. Now, a lot of these companies produce both natural gas in West Texas, or crude in North America. But what you're going to find is when both start to rock, these stocks can really, really surge. And so, if you wanted to, you could go to that FCG ETF and just Google FCG ETF holdings, and it'll give you a list of all the companies that they own and that kind of thing. So you can just go and find companies that have more natural gas than oil. You're never going to find something pure, but these things are looking, so sweet. So if you just whatever, here's Chesapeake. It's one that is just trying to break out here, and so you got a nice base formed at $4. This stock, I think everybody knows, but this stock was, you know, $29 like 5 years ago. So this is just starting to round up. Doesn't that look like a beautiful base just being built and ready to break out to the upside? This lime green line here is the 40-week moving average, and it's just about getting ready to cross it. So you're seeing really nice setups in all these stocks, and I'm not just picking on Chesapeake. Like going through the whole list, there's some great ones. So I would encourage you to take some time going through them, just looking. And again, if we just go back and look at that screenshot of the natural gas listing here, all of these companies are really active, and some of the stocks are really beaten down. These are opportunities for doubles or triples. And one of the things I've noticed in the last 4 years is that nat gas likes to make a seasonal low in February, and the stocks usually continue to ramp up all the way until April. So you could try and look towards that. But if all of these things are going to start to go, the second group that goes is the oil and gas service companies. And so, with that, we can just go into oil and gas services, either Canada or the US here. And looking at these lists, these stocks, this is 1 month, haven't started to move a lot yet, but as they get going, you're going to find huge moves over the period. So in the last week, some of these have really started to ramp up. And uh, one of the things I've done here is I've just deleted price and other data like that. But you can also put the scooter rankings on here and then just sort by scooter and starting to see what's starting to move better. I think there's huge opportunity still in the drillers. All of these things have lots of room to run. And the West Texas, even if West Texas starts to stall here, but natural gas continues. Don made a comment that the Canadian drillers, there was 50% gain in number of rigs booked just this week. So things are really starting to perk up. And I think when you see this big picture starting to show with the currencies, the commodity countries all breaking out, this is a macro trend move back into commodities. And I think I've got a couple of minutes left here, so I want to just take a minute and show you one other chart list I have called Market Summary. And in this Market Summary chart list, what we'll see here is this one. Okay. This shows the monthly charts for a lot of the countries around the world. And when they all move above their 20-month moving average, it's very, very bullish. Now, I realize the markets are super extended here. You might remember in 2007, when there was a small financial crisis that happened, the stock market rolled over from 15 to 600. Well, the oil stocks actually continued to surge all the way into midsummer of 2008. I think the high was in June. Crude went to 149. The oil stocks were rocking it up there. And so commodities can move independent of the other markets. And so that's one point I'd really like to make. They don't have to move together. But if you just go look at, here's the Japanese market or whatever, in 2003, when all of these commodities started to break out, they all had big moves, and gold broke out in this period in here. Things really started to accelerate. And, it looks so easy on on these monthly charts. But look at Australia. This was a ribbon, just literally taped up against the top of the Bollinger Bands for almost 5 years. Stunningly beautiful move. And I think the TSX, sorry for the scrolling, is a little farther up here, but it was almost as smooth. And again, we started to break down in June, was when we finally started to make lower lows. But if you look at these markets, they're really, really powerful. And here was the Shanghai. This was a 2006 launch. I think, I'm trying to remember what happened there that made that one so ballistic. But 2003, 4, 5, even with the Shanghai moving lower, commodities were on fire and all of the commodity countries were taken off to the upside. Here was the Hang Seng, and it was really doing well that whole period. So that was, I think we were using that for more of a gauge of, at the time, it was the BRIC countries, Brazil, Russia, India, China, and all of these were rolling together. And so the point I want to make is I feel like we're at the early innings of this big move now that commodities are starting to turn. This coincides with the US dollar rolling over in 2002 and going into 2003. So let's go look at that US dollar chart, because I have a place here that might have it a little handier. Yeah, right in here. Okay, so let's just scroll up to this US dollar and look at that 2002, 2003 period. So this is the current setup, and we're just breaking this top. And I'm of the opinion that we're right here. This consolidation that we had back in 2000, early 2003, when the dollar started to break down, is what we've just experienced, and we're starting to break down now. The RSI gave us a bear market signal in mid 2002, and it ended up being a beautiful bear market for 3 years. And the only reason it was beautiful was because you knew what was going on and you could trade the commodities on the other side. We've just got that signal for the first time in 6 years over here, where the RSI is now hitting 30s, which it doesn't do in a bull market. So all through this period, it stayed above 40. Now we've had a bear market signal in July. We were looking for a rally into the fall and rolling over. And this thing could just sit here and bang back and forth for the next couple of years. We don't know that yet. But currently, everything we have lining up globally, lining up on the commodities, lining up on the indexes, the currencies, everything's starting to align that this looks like the next macro shift. And if you just look at the MACD here, you'll see that all of a sudden this MACD is spiking to new 10, 13-year lows. Well, the same thing happened back here in 2002, gave us a nice signal change. And that oversized move to the downside after being so bullish was one of our biggest clues that something was changing. And so here we have it both on the MACD and on the RSI. And not only were we down here for a long period of time, like we spent years here, but we spent 3 months on an oversold signal with the RSI for the US dollar down below 30. That's crazy to get an RSI signal that strong. So with all of that, I think we're set up for a nice commodity run here. I'm with Don 100% that the markets might have run a little too far and need little time. But I think any weakness, you want to take the opportunity to try and figure out how to add some commodities into the portfolio. And commodity related stocks. So in conclusion, the seasonality and technical analysis tools are all aligning for commodities. The currencies are agreeing with that. And as we go, looking at these, that Russia breakout was fabulous, right? That's a brand new 52-week high just as we enter this trade here. And when we're starting to see these commodity markets worldwide all kind of take their cue together, that's another great place to look. So to wrap it up on our presentation stuff, and then we'll get into a few questions. I continue to look for global strength in energy. Don's looking for strength in crude to continue. Natural gas, not as much, but I think we're also seeing some change because of the way these things are working. And we continue to look for strength in materials. China's just starting to pick up. I didn't even show that chart, but the Shanghai's starting to perk up. The Hang Seng has been on fire for a year. So materials are ready to rock. We're starting to see the Baltic Dry Index, which is a shipping index for hauling dry freight, is starting to improve. All of these things continue to show a big, beautiful bull market. So with that, let me quickly run through some of the questions here. Just going to talk into my mic as I'm looking around. But, we've got Tom Boley was neutral on commodities. I know. And Tom is really bullish on banks and on biotechs, and I have no problem with that. I just cover commodities every week. And one of the things that I like to think about on commodities, and let me just go grab it here, is with commodities, what you have is one of the indexes one of the indicators that's here, and I think it was Larry Williams who created it, is called the Commodity Channel Index. And I'm just going to throw it on here. But the bottom line is that, you want to buy when things are low, and as they start to turn up, you want to pick up on this. Well, you don't want to wait till they're already in an overbought situation, like Don and I are both saying. Things have run quite a bit. It's not really the time to add the pullback.
Hey, Greg, if you're showing a chart, we cannot see it currently.
Oh, okay. Sorry. That's a good point. Why don't I go grab the screen? My mistake. And so let me do that. Share my screen. Okay, so this commodity channel index down here, and let me just get rid of a few years on this chart. It doesn't really matter, but my point would be, this is a bit like a full stochastic indicator, or a stochastic indicator, where when things are oversold, you're waiting for them to start improving and you want to buy that uptrend. Now, this is a weekly chart. So this is almost 3 or 4 months here where the US dollar started to improve, but you were getting higher lows in your commodity channel index and lower lows in price. And as this thing starts to surge out of there, you want to take advantage of that. Well, I don't want to wait until the commodities are overbought to start buying them, but I think gold is just breaking out. As we can see on this chart here, the gold line is in here, just breaking out to new, to test those previous highs. And it's going to take some time to get through. It's going to fight through for the next couple of weeks or months or whatever. But as gold starts to break through that, I think we get the same thing we had back in 2016, which was this huge move, as all the currencies changed trend right on this spot, also beginning of the year, right on this spot. And this was a 150% move in the ETF. Some of the individual stocks were 300-400% in 6 months. So I don't know if that's what we get, but I'm just saying everything is set up with the currencies and the commodity countries and everything starting to break out now to at least look that way. Okay. What else have we got? And so, do I have a view on platinum? I don't even look at platinum. Let me just go get it. Don, do you have a view on platinum at all?
Yes, seasonality for platinum is very positive this time of year, right through until approximately the end of April. Recently broke to new highs. Technically looks very, very strong.
Yeah, that's a beautiful chart. And there's a little downtrend here that looks like we're either breaking it this week or just broke it. So that's a really nice one.
Palladium actually has even a better chart.
Yeah, and that's palladium. I'm trying to think. PALL, I think, is the ticker. Whoops, dollar palladium. So there we go. Yeah, that's a bit of an uptrend. Bottom left to top right. That's a smooth one. So that one's really, really nice. Okay. I don't know. And Don, what other comments do you have for us just to wrap up?
Yeah, the comment about the biotech sector is kind of interesting as well. The sector normally does very well prior to a big conference in San Francisco, which is starting next week. The sector has been actually quite strong during the last little while. FBT, for example, which is one of the biotech ETFs, just broke to all-time highs just a couple of days ago. So that sector looks interesting, but it is a trade, and be aware that that trade does end sometime in February.
Yeah, and the biotechs have had a great year. Interestingly enough, the one thing that I will say about the commodities, when they're out of favor, they're really out of favor. And when they come into favor, they can move as fast as a biotech or a semiconductor. They really can have some nice acceleration. So I think across the board here, there's lots of opportunity. And again, the one thing I like about the biotechs is they can trade, or sorry, the commodities is they can trade independent of the indexes for quite a period of time. But I think we're just at the phase where we're having a global breakout for commodities, and it's a nice part to get in, a nice place to get on board. The one thing Martin Pring will say is, when you're in a bull market, don't try to figure out when to get in, when to get out. Just try to ride it. And I think that's one of the bigger pictures here that you really need to consider. The stuff Don's put together, the stuff I've put together, and again, tried to use big picture charts, not so much, this week, but looking at longer trends. And lots of the stuff we're seeing should run well into April. So if you get a pullback, it's a nice place to try and grab that. So with that, let's wrap it up. And I want to say thanks a lot to Don for coming on the show. If you've never seen Don's work, you can go to bnn.ca. Don is a regular guest on there, and you could just search for his last name, and it'll bring up all his stuff. Don, when was the last time you were on BNN? It was just this week, wasn't it, or 2 weeks ago?
About 2 weeks ago.
Yeah. So Don is a regular on there, and they have a great show called Market Call where people call in and ask about a stock, and then they commentate live. And Don does a great job when he's on there. But with that, I'd like to say thanks, Don, for coming. Thanks everybody for taking time out of your Saturday to join us. And this will be recorded, so you can go to the Stock Charts YouTube channel. And you'll find it there. So again, thanks everybody. Have a great weekend and good luck trading this month. And we'll catch you for another edition of Market Outlook on the second Saturday in February. Thanks everybody. Bye-bye.